This is Intelligent Investing presented by Fidelity Investments. At its worst point last Friday, the S&P 500 had fallen 12% from its intraday high on January 26th. According to Fidelity Investments, Director of Global Macro, the recent pullbacks were the result of two market imbalances. One imbalance was caused by the stock market gaining twice as much as was justified by the recent tax cuts. Last August, tax cuts started to get priced into the market again. From that point on, the S&P 500 rallied 457 points to its recent high. Jurrien Timmer says, conventional wisdom on the street has been that the corporate tax cuts are worth around $2 per share per percentage point in the effective tax rate, or $10 a share in total if the effective tax rate declines from 26% to 21%. So at a PE ratio of 20, that equates to around 200 S&P points, with the other 250 points coming from PE expansion. Timmer says to argue that PE ratios should expand even further because of the tax cuts is technically correct, because earnings growth is likely to be sustained with permanent tax cuts. But in this case, it's hard to justify given how elevated valuation levels already are. The second imbalance was the stock market's lack of attention to the sharp rise in bond yields. It seems stocks are now paying attention to bonds again, which is good, and the number of rate hikes being priced in by the market is getting closer to the estimates from the Fed. So according to Timmer, the good news is that these two imbalances, rising rates being ignored by the stock market and valuation multiples rising beyond what can be justified, have now mostly corrected. Timmer says the market is now in much better balance, with strong earnings growth pushing the market higher, but higher rates acting as a headwind for valuations, meaning stock prices should rise less than earnings growth, not more than earnings, as they have for the past several years. With double-digit earnings growth, he believes this is still a bull market scenario, though a late cycle one.